Good morning, Todd. How are you?
Good. How are you doing?
I'm good, and this is awesome because I've only had a couple people on the show twice. You and Ken Sangenario being two of them, and both. You actually, I think you introduced me to Ken after I met you 4 years ago. So we're kind of doing a little bit of a time travel here, and I'm excited because as you and I were just talking about before the recording is, as we look at, what we're doing at Arcona with the 5 growth and exit principles and talking about the team of advisors, preliminary due diligence, and you literally changed my perspective on the things that are possible after I saw your presentation at that EPI event a couple years, probably 3 years ago. So the listeners that might not have listened to that episode when you and I were talking about your expertise and some of this stuff, I've learned a lot over the years. But let's maybe we can kind of take the episode in chunks of let's give you your background and then kind of talk about kind of what you guys are doing. And then we got a lot of stories about how wealth tax is legal, deal structures, net proceeds are all stuff that they all are intertwined dramatically. And you have a very unique skill set of understanding how they all impact each other. And you're doing some really interesting work to help people make more money than they could if they hadn't gone your direction. So, you've got a super interesting background, Todd. So maybe just kind of give the listeners, how did you, what are some of the milestones that got you where you are today?
Okay. Well, okay. Thanks. So actually, I started out in my early career. I was actually an Air Force officer, and I credit the military for a lot of my just personal management style. I had so many opportunities in the military to lead and manage and so forth. But subsequent to my military service, I became a business owner. And I have also both acquired a business and I've sold a business. So I've kind of, as the business owner, I kind of know what it feels like. And, through all of the, well, I won't say heart wrenching, but all the.
Oh, that's what it is. You can be honest.
Yeah. The anxieties that occur is this deal going to go forward? Is it not? What are the due diligence issues that come up and so forth? So I've been through it both on the buy side and the sell side. My passion has always been about taxes. And so I have a law degree. I have an advanced law degree in taxation. I've passed a CPA exam in one state. And early on, it's not like you just sort of pick stuff up and say, okay, well, now I'm doing this. It really takes years and years and years, no matter what one's discipline is, to really get to a point where they're really proficient. The other thing that I feel about any discipline is that you can't, like so many professionals, they just say, well, I got my meal ticket and that's it, I'm done. For someone to really be top of game, top of the profession, it's a constant process of always learning. You're never there. You always have to, like a business owner, and the business owners listening today will understand this. As a business owner, you're always thinking, what I have yet to do? What's the next thing I got to do? I can't like that. Okay, everything's on cruise control. Okay. Well, with professional advisors, it needs to be the same thing in terms of, what's the next thing I need to learn about? And as you and I have discussed, it's unfortunate, but there are a lot of professional advisors there in whatever discipline who, they're sort of the first type I mentioned where, they have their meal ticket and they just sort of do stuff. But when it comes to the more advanced things, they may not even be aware of some things. And we can talk about that as we go. So, but what my team focuses on now is advanced planning, tax planning, and you can throw in the estate planning in there too, for families that own middle market companies. So, companies that maybe have revenue about 10 million up to maybe a couple hundred million. That's what we do. And so when we go through this, we're not really trying to look through it as a lens of, well, okay, I'm just a tax planner. I'm trying to look at it in terms of, what an accountant's going to look at, what a business best practices advisor like yourself is going to look at, or even the M&A advisor is. So we try to look to bring all of these disciplines together. Whereas in so many cases, you'll find that a professional advisor within a given discipline, that's sort of like their thing, and they're sort of unaware of anything that happens outside of their little sphere.
Mm-hmm.
So
and you, I'll kind of set some of the foundation here, Todd, because like I said, you were one of the people that dramatically changed my level of I'm trying to think of self-awareness of how little I knew because I was watching your presentation and then I realized how little other people knew around me. And it was just a lot of this blind leading the blind. And, a couple of the things when I say setting the foundation for some of our conversations is that when you talk about looking through the lens of all these people, we have our 5 principles. And then I explain that once the owner knows what they want from the first principle, then they know what their financial targets are. So I need, net this much, this lifetime income. This is the value of my company. What are the different exit options? So they might be marching towards an ESOP or a private equity or a third party. And then they've got the ways to increase the value of the company using Ken's tools. And then we have the team of advisors. So for the first time, you should have all your advisors that are looking at the same map and the same blueprint. So with that being said, when you did your presentation, that's where I literally, Todd, still give it my keynote where if I would have done different things that you had suggested, we'd have saved millions of dollars net. But it's different. What you're talking about, what we're about to talk about in the show is different than the internal value building inside of a business. This is technical from the entity structures, the taxes, the real estate, different entities from different companies or different, if they got different companies. And I'll give my example of what I say to people where I had this client, and if they're listening, they'll know who it is they have probably, 7 or 8 houses, I think, they're building commercial buildings, and they've got a couple different entities, and the parents' net worth outside the business is pretty significant. Yet they came in and they're working on a family transition, and then the father was like, I want to move to Florida today. And then it will, right? And I say it ripples into the wealth plan, the tax plan, the real estate plan, the insurance plan, the estate. It's everything. And so when people don't think about the stuff that we're about to talk about, it's not just the due diligence from a buyer's perspective on the operations, but it's how much money you leave at the table that could impact whether you decide to do a certain exit at a certain timeline that can make or break the entire situation. So, before we jump into the kind of maybe give your overall opinion about how all these different designations tie into different outcomes that people might be trying to march towards.
Well, so where do you begin?
Yeah.
So, one thing that we talked about, previously is the need for lead time in doing all of this planning. Okay. It takes time, whether it's just the value growth proposition, it takes time to make the appropriate changes within a company, capture that value if you're doing that. If it's taxes, it sort of depends on what the specific objectives are. Like you were saying, you have to know what those objectives are. And that will then dictate how much lead time you're going to need, because it says either how more straightforward or more involved a scenario might be. But what you just said about dad wanting to move to Florida, okay, I got to tell you. So when anyone asks the business owner, so when do you think you're going to sell? And they're going to say, every single one of them are probably going to say 3 to 5 years. Okay, that's just
sure.
That's just the way it is.
It's
no matter who
3 to 5
asks
years,
them.
right?
But when you then talk with, if it's let's say an investment banker, what then happens? And so I should take a step back. When the business owner says, 3 to 5 years, they think, oh, well, this particular plan or that particular plan, I have time to implement, so I'm going to put it off. Okay. But then now you have the conversation with the investment banker, and the investment banker says that, yeah, they say 3 to 5 years, but one of two things typically happens, and that is an out of the blue offer comes in, and it's juicy enough where you can't really refuse it. But then you haven't had time to
Mm-hmm.
put any of your value enhancement or tax planning things into place. The second thing relates to dad moving to Florida is look, every business has its challenges, and so it comes to a point where whoever the business owner is, they roll out of bed one day and say, I'm
I'm
done.
done.
I'm done.
Totally.
Uh, just sell it. Just get it sold. And so, but they haven't done those things, whether either to enhance the value or to preserve value on taxes. They don't do it. And it's funny. So I should actually mention that, I have the Forbes column. So if someone
Mm-hmm.
just Google my name, Todd Ganos, Forbes, a lot of the subjects that we may talk about here today or others would be on my Forbes column online. But yeah, that's the thing is exactly what you said. It takes time, and yet one wild card that's in play is the business owner gets a out of the blue offer that they feel they just need to take, or they wake up one day and said, I can't take it. I need to sell.
And those two lights too, Todd, like which, because I think we'll just for the listeners so they understand where we're going to be going with this is that, I've talked a lot, I talk a lot about on the show of our fourth principle, which is enhance and increase value, which is, the operational stuff from strategic planning to the finances to sales, marketing stuff. That's, we're going to put that to the side when we talk about the principle number 5 with the team of advisors and optimizing the tax plan and the deal structure and the stuff that you understand too, because you can't do the value enhancing things last minute, but also it's the stuff that we're going to talk about from the different deal structures and the corporate structures and all that stuff, where if you get an out of the blue offer, I mean, like all that stuff goes away, which might impact your
Yeah.
second principle of your financial target. So if you're kind of going back and forth of should I or shouldn't I sell, and it's a difference of a couple $1,000,000, and literally some of the stuff that we're going to talk about could make it where you would want to sell if you got that offer had you done these things. So it's maybe explain how. I mean, I don't know if there's specific examples of like how the deal structure or the taxes, corporate structure, different kind of a couple of different examples of how it ripples into all those and how it actually could impact the taxes that you might pay and what goes in your bank account.
Sure. And so just to give two examples that are real fresh examples that have just come up very recently, I think are worth talking about. So with one of the families we serve, they own a number of businesses across the United States, and they were in a process of and so we actually, for this family, we have all the trust in place. We have things domiciled in Nevada, even though the businesses themselves are somewhere out there in the various states. But in terms of the top level ownership, we have the trust set up and everything's in place. Well, but then, and so we've done the planning early, but then the family says they have 4 businesses that they're going to sell. And in one particular case, the business is located in one particular state. And the business is organized as an LLC. And you say, okay, great. But because of the way that the ownership was set up and how the transaction was going to take place, that sale would have been pulled into taxation by that particular state. And so on this case, it was an easier fix. But when we got word of this, we said, hey, hold the phone. And it took us basically just an afternoon. My gosh, it took us an afternoon, but we were able to do certain things, open certain bank accounts. We keep certain, entity, sort of standby entities ready to go in case of such emergencies. when we need to adapt a structure. So we're agile in our planning. But the net result of this is, had they not given us the heads up, they would have been sucked into the state to the tune of $2 million of tax. Okay. So even though you think you have stuff set up, there was this blind spot, and we caught it, and literally in an afternoon we had it solved. Now, a second case is where there's a completely different family, and they have it's an e-commerce business. It's an old line type of industry, but it's now being executed via the internet. And in this particular case, their CPA, who has been with them for a number of years, had advised them to make certain tax elections, because in making these tax elections, they would have saved money on their Social Security taxes as owners. And you say, okay, great, that sounds really good, and so forth. But this advice, when it comes to selling the company, was fatal, absolutely fatal. And in this particular transaction, this decision to say, hey, let's save on the Social Security, and we're going to make these certain elections, and think how many dollars you're going to save there. The anticipated sale, if it was not, I'll just say, reconfigured, it would end up being about $6.5 million of tax difference.
Which could make or break whether you even want to sell the company.
Well, for some, certainly. And actually, what you just said reminds me of a third story. And it actually has to do with a very old line. Turns out it was waste management. And there was a gentleman in the Midwest who was going to sell his waste management company. And the way that it was set up as an S corp, and I'll just without getting into technicals regarding S corps, but the one thing that he was kind of locked into was he had a lot of depreciated assets. Mm-hmm. And when he sold the company, and he was going to use a particular tax election in the sale of this S corp, he was going to experience something called recapture. And so anyone who is invested in real estate is kind of familiar with this. Is you have an asset that is, let's say, worth, you buy it for $100, and you depreciate it over the course of time by, let's say, $40. So if you sell it for more than your adjusted basis of $60, between the $60 and the $100, you're going to pay, in essence, your ordinary income rate, because you've benefited from the depreciation deduction. Anyway, not to get too technical here.
It's okay, because some of these things are, I think the people are okay with, because it's actionable. And like, there was a gentleman, just as a small comment on that, he was on my show, Todd, and he found out his depreciation recapture at the deal table. So he had like a bunch of equipment. So call it, I don't know if it was for hypothetical purpose, say it was a couple $1 million. And then all of a sudden you're paying ordinary income on that you were not aware of.
Yeah. And it's the exact same situation. This was millions of dollars. And it turned out that the tax on the recapture was going to be $600,000. And he said to himself, why do I want to sell this thing then? Okay. And so his M&A advisor, came to us, and we said, well, okay, look, we can restructure this in a way where you would not be subject to the recapture. Essentially same transaction, but avoiding the recapture. And that was a $600,000 swing. And for this gentleman, it meant that, sort of the thing you said is that in one case you say, another $600,000 in tax, do I really want to sell? Well, this, by just doing simple restructuring, enabled him to sidestep the tax, so where he's not legally required to pay that tax, and he was in good conscience able to sell, and he lived a happy retirement.
Did you create it? Was it through trust and estate planning, or was it different entities?
No, actually, in this particular case, it did not require a trust. It was actually a very simple fix. And and that's the thing is some fixes are easily done and they don't require a big structure or anything.
It's
And
just
yet,
someone that is familiar with M&A that's in the tax field.
correct. A few years ago, there was this investment advisor who had a client who had a medical devices company, and this was in California, and he had already sold his company, and um, and it was after the fact that this investment advisor had his client come to me, and we reviewed the situation, and it turned out that this gentleman's CPA was unaware of an election. And it was the kind of election that we could actually do retroactively to amend a return and claim the exclusion that was applicable in his case. And
It wasn't the 330 to H10, was it?
no. It turned out that it was a C corporation, and it was a what's called a Section 1202 exclusion of gain. Anyway, but anyway, we can get into code sections really quick.
No, but and go ahead. Sorry.
In his case, it ended up being about $1.25 million less in tax. The unfortunate thing was that he came to us a month after the statute of limitations to amend a return. And the other actually sad part about this is that prior to this gentleman selling this medical device company, he had asked his accountant about a particular tax saving strategy, and his accountant, without even investigating the strategy, told him, "Oh, don't you believe any of that stuff? That's a bunch of hocus pocus, fraud stuff. That doesn't really work." Well, for this second strategy, it does work. And as you know, that when we do planning for business owners, in certain cases we obtain an advanced ruling from the
and I want IRS you to explain that, because it is something that most people don't even know about.
Yeah, and so with this gentleman's case, so far the IRS has favorably ruled about 100 times on the situation he was inquiring about, and his accountant was just unaware. Okay, so these advanced rulings. So if someone has what's called a proposed transaction, so something that they're anticipating doing, but for which the tax event, let's say a sale, has not yet occurred. Okay, and so the IRS has a process whereby you can obtain an advance ruling, and it's called a private letter ruling, or just a letter ruling. And essentially, what one's tax advisor does is they, whether it's a structure or it's a trust, there's a copy of the trust document that goes to the IRS with a cover letter, and the cover letter outlines what the tax issues are being asked to be ruled upon, and so it's this tax character A, B, C, D, E, and so forth. And you're saying, okay, these are the things you want to know for sure, and this is what we, the advisor, sees as the law that applies to the A, B, C, D, and E. Okay, and so not only will it be the Internal Revenue Code, but it will also, this letter will also reference something called the Treasury Regulations, which is how the IRS implements the Internal Revenue Code, and it goes into, I'll just say, great depth. They give explanations, and so if you think about how big the Internal Revenue Code is, which I'm going to say is big, the Treasury Regulations are about 5 times the volume. Okay, because again, they get into examples and they provide illustrations and so forth. So this ruling request goes in, and it goes into the IRS's Office of Chief Counsel, so their top legal officer, and the Chief Counsel has a whole staff of attorneys whose sole function is to rule on these things and then also to develop those regulations that implement the Internal Revenue Code. So it's going to be a tax attorney at the IRS who's going to be reviewing it. And what they'll do is they'll say, okay, this is what you're telling us. This is what the facts are. And this is what you see as the legal reasoning of why tax character A, B, C, D, and E should be the case. So they then have their own analysis. And then at the end, they say, as for tax character A you're looking for, we agree. Tax character B, we agree. Or they could say, we disagree. Now,
and this is
I
all
have found
before you sell.
Before the transaction occurs.
Right.
Okay?
Ways
this
before.
Is before. Yep. This is before. And
you can't do this on the goal line, right? I mean, it's
no. And so this is important for the listeners to understand. It is one thing to do a transaction and you say, I think it's going to work. The IRS on audit does not know what your state of mind was when you did this, okay? But when someone applies for an advanced ruling and they get the tax character down, they understand that your state of mind is that you're trying to comply with the law. And you're asking, Mother, may I? Okay? And so they understand you're trying to be a good guy or gal, okay? On audit, they don't really know. But when you have one of these advanced rulings, it is going to bind the IRS, as long as you haven't misrepresented the facts or anything. But the IRS is going to be bound by that ruling. They can't on audit. If someone gets audited with you say, here's the private letter ruling. You said I could do it. And they say, oh, okay, we're good. Okay. So that's the benefit. And in some cases, there are states that say, as long as the tax law in our state is substantially similar to the Internal Revenue Code, if you receive, what they call administrative guidance, but guidance from the IRS, like one of these rulings, if you do that, it will bind us as well. Okay. And it actually works out that the state of California, their chief counsel issued a notice several years ago saying that if someone has a private letter ruling from the IRS and the tax law is substantially similar, it's going to apply to California as well. So, some states, it depends, but in general, what we do is we get this advanced ruling. And I should also say to your listeners that when you're doing this and the IRS understands that you're trying to comply with the law, okay, you're coming ahead of time, make sure you get it right. I have found, and we've done this, and I'll just say a number of times, that the IRS attorneys are very collegial. When you submit it, they review your request, they give you a call. It's okay, what are we trying to do? And you say, well, we're trying to do this. And it's not, they will have seen this type of request come in, especially if it comes from us, it's going to look substantially similar to the prior one we did. And so it's not going to be like, well, reviewing this afresh. Okay. And so they'll say, okay, what are we trying to do? It's okay. And they'll go through the document, and we've actually had the IRS attorney say this. If you change this sentence to read this instead, we'll approve it. It's like, they're giving you the solution. My gosh. So this process is, and from their standpoint, okay, you got to think that, look, every organization has constrained resources, right? Everyone's trying to get what they need to get done in as efficient a manner as possible. And so from the IRS's perspective, from the Office of Chief Counsel, they're looking at this transaction And if they can tell you, look, do this, and then they give you the chance to resubmit it on the same on the same application, what happens is if they instead were to say, well, no, just disapprove, they don't want to have to deal with a second request and go through the whole rigmarole again. They're saying to themselves, look, this person is trying to comply with the law. And if I can just get this thing buttoned up by just giving them the way I want the sentence to read, I'm going to give them the sentence the way it should read. Boom. And I've got this matter solved, and I don't have to wait for, 3 months down the road for them to submit a new package on the same matter. I want to get this. I'm going to help them comply with the law, and I'm going to move on, let them move on, and I'm going to move on as the IRS's attorney to bigger and better things. And, I have to say, this was, oh boy, it was maybe about 3 or 4 years ago that there was someone who we were talking with, and this individual had an e-commerce business, it turned out, and his stake in the company was about $18 million. Okay, and the IRS charges, not us, but the IRS charges a user fee when you apply. Okay, and over the course of the years, the dollar amount of the user fee the IRS charges, is varied. It used to be one. Now it's about $30,000 if the applicant's gross income is over $1 million a year. And so you say, well, if someone's making $1 million a year, well, and we're looking at almost a $20 million transaction. I mean, how much is 30 grand? But this particular person was like, I don't want to have to pay $30,000. And it's like, wait a second, you will get certainty in your case. You will have uncertainty without it. And sometimes, and look, it's not as if, they're paying, my team $30,000, but even no matter who the professional advisor is they experience it. In my experience, the professional advisors, they add value to the business. And so in your case, I use the term best practices, but value growth, but basically helping the owner do things with their company to enhance the value.
So on that note, Todd, I want to kind of because this is a good, I want to spearhead this, because when we talk about these advisors, because I think there's a big, huge challenge, because you're right. From going from, you and I both been on the owner side of the table. I'm now kind of on the trusted advisor side of the table, where you have the one kind of quarterbacking everything between the value enhancement, internal stuff, and the outside advisor stuff. But the internal stuff, you're going, okay, I implement an ERP system, I do a quality of earnings, I do sales and CRM materials, I'm going to increase my multiple, right? So once you start focusing on value creation, you can more probably, I would say, through normalized EBITDA, you could quantify the spend that you're doing. So then you got the team of advisors where the owners that I've worked with, and I was very cynical myself when you and I met 5 years ago about how no one really did extra above and beyond work to collaborate on all the stuff that you do. So in being able to quantify, okay, I've got my lawyers, I've got my CPA, I've got my wealth, I've got my insurance, I've got estate, tax, asset protection, like you guys, who technically should be, spearheading the whole thing. Let's maybe take a sample or example in how that you would chunk that off into a process to actually build the return on the value of the proceeds, which you do. So maybe you want to bear with me, and I can kind of give you some of the decisions that I see owners have to make all day long. So you have real estate. So let's kind of go paint the picture of a typical entrepreneur, and then this is kind of based on the case studies that we have in our boot camp. But let's say you go, okay, I got a couple pieces of real estate that I own that are getting leased to the business that I also own. Maybe you've got a couple entities as well. You have assets outside the business. So you have these decisions. You say, okay, well, I've got different entities. You might be an S Corp or C Corp, an LLC as a registered S Corp. elected as an S corp. You have different partnerships in these different entities. You have all of this stuff, right? And like how that whole jigsaw puzzle works, like I keep saying, ripples into tax, legal, estate, and wealth. Because if people are trying to solve for annual income and say, okay, I want to solve for this much passive income, which means I have to harvest as much value out of what I have outside of the value enhancement stuff or the best practices in the business. There's all the stuff that we're talking about, right? So maybe kind of go through some of the things that you see, or the decisions people might have to make, of like corporate structure, or like how the real estate works, or how the trust and estate planning works on top of it. And you don't have to go into major details, but just explaining how those, what I've always tried to get across that is how interconnected all those are. And most of the time the advisors don't know how all of it works, and the owner doesn't. And so stuff gets left on the table, like you showed me about our deal. Maybe does that make sense, to kind of the different variables?
Yeah. Okay. So exactly as you said, you want to ask the question of the owner: how much annually do you really require to live on? Come up with a budget. Now, we've those budgets can vary greatly, but we've worked up budgets for retirees, and the basic side of just sort of living tends to be pretty consistent. The big variable has to do with travel and entertainment.
Mm-hmm.
Is for most, and some people, they're conditioned to think about what their lifestyle is and how much they spend and so forth, and but you figure a number X that excludes travel and entertainment. What typically happens on the travel and entertainment side is it starts off big, and then as one gets older and is probably less likely to travel, it declines. It probably peaks around the age of 70 to 75 maybe, but then as I say, by the time you get up to 75, you start saying, well, let the kids come here for Thanksgiving. Okay. Or by the time you get to about 80, you say, well, look, I'll go to Yellowstone, but I'm not going to Timbuktu. And so your travel really changes over time, and it declines. So, but you have that basic living component, and but in either case, you say, how much do you really need to live on? And you come up with X dollars. And then you say, well, okay, if we have the investment professional in the picture, they're going to say, well, okay, you multiply that number by 20. So you figure about a 5% distribution of whatever dollars you have is going to equal X. So now what's happening is you're backing into what we call the required capital amount. And so if we were to say, and I'm just going to pull out some numbers, if we were to say that someone's number is, and I'm just saying $100,000 a year, we'll multiply that by 20, and you need $2 million of required capital. If
Todd,
the number
I was just going to say, in the presentation I give on our the 5 principles, like the financial targets principle, is reverse back into 200 grand. You need $5 million net. Because we do 4%, but not we. Okay. It's like just basic, like you said, concepts.
And I was going to say, if you needed 250,000, you need 5 million. If you use a 4% distribution rate and you feel your target is 200, same concept. Whichever you want to use, a 4%, 5%, you figure out what that annual budget is, multiply it up. That's your required capital amount. Okay. Everything above that is excess capital. Okay. It's excess capital. And the question from a planning perspective is, well, what are you going to do with that? Okay. And so if you were to say that the owner retires at 65 years old, and let's pretend that she's this business owner, she's going to live another 25 years. Well, and she's not going to draw on this excess capital. It's just going to grow and grow and grow. Well, how
That's
much is
without touching the principal. I mean, yeah.
well, that's what the required capital is what you're going to draw from. This is excess capital.
Mm-hmm.
And so if you are saying that this is going to grow over 25 years, I mean, if you simply assume a moderate rate of return of, let's say, 7%, that's going to go eight, multiply 8 times. So if your excess capital, it ends up being $5 million, you're going to have $40 million. Well, I'm going to tell you that doing estate tax planning for $5 million is a heck of a lot easier than doing it for $40 million. Okay. And so the earlier you do the planning, the less of a problem it is, right? So
Well,
this is a concept.
Well, and then I think about, okay, so you're totally right, and this is exactly where our framework goes. And then now think about where your expertise comes into play. Like once they have the outside edges of the puzzle like that, then they say,
Yes.
okay, now I've got 3 entities, and then I've got real estate, and I've got all these these things that are inside that, which usually are not just a 401k that's illiquid, right? Or that's liquid, right? This is complicated stuff that gets the ability to, that excess capital when we're trying to solve for that $5 million. Like when you had talked about I don't know if it was a 338H10 or the Ning at our point, there was stuff that was millions of dollars that would have gone into our net proceeds into that framework, which would allow us to have different decisions from the exit options from family transition to ESOP to private equity recap and how much you need up front. So kind of explain how that ripple effect happens from all that stuff.
So again, we're working back in time. We're starting out with where the person needs to end up, and we're going back in time to say, now what needs to happen in order to get there. What it's sort of like is something that Wayne Gretzky, the hockey great, said. He is going to skate to where the puck is going to be. Okay. And what we need to do is we, by asking the business owner, where is it that you want to be? We're saying, where's your puck going to be? And then how do we need to skate to get to where the puck's going to be? Okay. And so once we have all of this financial stuff set up, we now have to go in and see 2 things. On one hand, the operational stuff, which is what your team does. They go in and they say, look, whether it's inventory policy or this or that or CRM or whatever it is, the operational thing. Then on our side, we talk about the structural things.
Mm-hmm.
And so, for example, if someone has an S corporation, and I'm just going to say that the days of needing an S corporation as such are behind us. The tax court has ruled that on the key benefits that an S corp has are experienced by LLCs that are taxed as partnerships. So there's a way to get the S corp benefits, and we won't get into those specifically. So, but the challenge with an S corp is that it has certain restrictions to it and certain benefits that an LLC would have, certain tax elections that LLCs have that are simply unavailable as an S corp.
Well,
and I mentioned.
As I say, if you can, I want to go back and make sure you kind of list a couple of these because I want to really just hammer this point home because also when we going back to our principles, one is the drivers, second one is your financial targets, which we just talked about, and then the third one is the exit options, which is where's the puck going to be. And so like in that situation, and if you want to kind of just as you continue your example, like if you wanted to do an ESOP, whether you have a C corp or an S corp might make a difference, and you can't do an ESOP with an LLC. So all these decisions you have to back into to weigh today's annual tax burden versus the final exit. And so maybe just keep that in light as I'm kind of constantly just hammering that because people make those decisions without thinking about where the puck's going to be.
Yeah. Okay. So I'm going to go back to an example that I mentioned earlier, but before I do that, I want relate a story that a few years ago there was this person who said to me that, and he's sort of a tech guy, there should be some algorithm that we should be able to just plug stuff in and a number pops out. And I said, it's not that easy. He says, no, this should all be easy.
Come on, we can do this with happiness and emotions too.
Okay, and so this example will illustrate why it's not just this simple cookie cutter process. This example that I'm going to go back to shows exactly why everything has to be tailored. And it's not just, we just run through stuff, cut and dry. Okay, so I mentioned that more recently there was this old line industry that the owner has implemented via e-commerce.
Mm-hmm.
And he has an LLC that his accountant years ago had recommended they be treated for tax purposes as a corporation and then make an S Corp election. Now, this particular company through e-commerce has sales in many, many, many states. Okay?
Mm-hmm.
And because of a particular ruling by the U.S. Supreme Court several years ago, as the seller, he has a duty to collect and then pay sales tax on his sales in all of these different states. Okay, he accepts it. He knows this is something I got to do. Well, when there's a buyer, okay, and the buyer is doing their due diligence on a company, and they're going to see, among other things, they're going to see, oh, you pay sales tax, and you pay sales tax in 45 states. Oh, well, it's great that this company we're going to buy has sales in all these states. But what we're not certain about is whether you have correctly paid and filed the sales tax returns with these 45 states. Okay. And if we buy your entity, it's the entity that is on the hook. And if we buy the entity, we're going to be on the hook. But if we just buy your assets instead of buying the entity, which is, and this is kind of why like 95% or so of all sales are asset sales, is one of the reasons is the buyer doesn't want to inherit the entity's liabilities. And so it's not just the sales tax. It's going to be, well, what about the employment taxes? Okay. And what about anything else? And here's another one is for those companies out there, let's say they're a roofing company, just as an example, or they make a product. Is there a warranty liability? So usually companies that fabricate or install will have a fund that they keep to deal with warranty work. Whether it's labor to fix the one roofing tile that just didn't work or whatever it is. But usually they have to keep, if they're in GAAP compliance, they usually have to keep a fund for those warranty cases. Well, they don't want to have to inherit the warranty issues. Okay. So there's a lot of reasons, incentives, why the buyer doesn't want an entity sale. They want to have an asset sale. And so in this particular case, going back to the e-commerce, it's the situation. And so we've told the owner, because of all of these due diligence issues, the likelihood is you're going to have an asset sale. Now, the problem with the asset sale is there are going to be certain elections that affect your tax status of how that gain is going to be taxed, whether it's going to be subject to state level income tax, or if we can remove it to the, as I say, tax-friendly state of Nevada. And there's ways to do it with this IRS private letter ruling process I mentioned. Okay. And whether there may be, if you have depreciated assets, whether there's going to be recapture or not, and so on. But the problem with the LLC having had this S Corp election is you can't take advantage of the planning techniques. You can't, period. You're dead. And you will suffer and I'm going to use that word, suffer the full brunt of taxation on that sale. You're going to pay state level income tax. You will not have the opportunity to legally sidestep state level income tax, and you will experience recapture, period. Okay? So now the good news,
all of that instead of capital gains with a stock sale.
And so pure capital gain treatment, okay? Right. And the elimination, the legal elimination of state level income tax. And so now the good news is this particular owner has the sight set on 3 years out. Well, we can go ahead and correct these structural issues. And I'm going to tell you, you can't put this stuff into an algorithm. Okay, you can't put this into like TurboTax and figure it out. This
is engineering at its greatest.
Subjective issues. Whether one entity can have an election or not, it's just too complex.
Well, and if you think about what Todd of especially the fact that he's 1 to 3 years out, so he can pre-plan all this stuff. But then also, when you have the difference of okay, I'm marching towards, I want to do an ESOP, but maybe you get the out of the blue offer, right? And it might be from a PE firm or strategic buyer, and what they want might be different. So maybe explain how the real estate or different entities impact the estate plan and the exit.
Oh, sure. So
just because you're talking about the corporate structure and the asset versus and some of the stuff, but thinking about where you want to go and knowing that there's because your examples, there was one LLC elected as an S, but they could have multiple entities and multiple pieces of real estate that the real estate might be owned by the entity or not. The point I'm trying to get across is that you're going back to the excess capital and advanced tax planning and estate planning in light of, how do you optimize this in light of where you're trying to go with the puck?
Oh, well, yeah. It's a lot of these subjective considerations. So one of the things that, as you've just mentioned, that we often see in so many businesses is that the real estate is peeled off and held in a separate entity. And now, so with the advent of this new Internal Revenue Code section 199A that allows certain businesses to receive a reduction in taxable income, and so, but certain industries are phased out very, very quickly, and so what some businesses have done is they've stripped off their non-core employees and they form a second entity to handle all of their back office people, so to speak, their administrative people. So if it's HR, if it's financial systems and so forth, administration, they peel that off from the operations, because as administrative functions, those are not subject to this limitation on the 199A deduction. And so, not that we're going to talk about, well, how do you exploit the 199A? The real point is that some business entities might find themselves very easily with 3 entities. Okay, one that's doing the operations, one that has the administrative support personnel, and then a third one that holds the real estate. So my point is each company one might talk with might in fact have multiple entities for the same
reasons. Yeah.
I mean, in effect, under the same umbrella. Okay, and so now the question becomes, well, now how do you structure all those? Okay, how do you structure all those? I would say is in the same way that knowing the ins and outs of with this one e-business, the sort of the subjective things that come into play regarding S corporation, the same sort of art to understand how things can be structured, or if you're going to use it, it really is best structured this way. And the only thing I can say is it's more of an art rather than a science. There are these technical rules, but the question is how do you apply them? And so, yeah, there's this Internal Revenue Code section that says, well, if your entity is categorized like this, it'll work this way. And it's like, well, but now how do we apply that?
To and I call it the ripple effect, right? To everything else that you
Yeah.
have going on, because
Yeah.
like when you think about what you're talking about as you're structuring this stuff for the eventual sale, my imagery brain, I think about like estate planning as the wrapper around your ultimate goal. Because you're dealing with the taxes annually, then at the sale, and then also post closing or transition. Where like I've talked to plenty of people, or that are, whether the 1031 exchange comes into play, or like a 1031 exchange, and I'll be doing a podcast soon about this, about 1031 into an opportunity zone, because you're constantly deferring these taxes, but the estate plans are wrapped around all that. So instead of just doing that stuff in pockets, it's about your whole thing of asset protection by understanding how all these variables work. And I just see too many times, I don't know if you got any comments on that, but people just making those things and just complete vacuums without understanding the ripple effect.
Well, and and I guess part of the challenge is whether the professionals serving the business owner are even aware of benefits, or I'll use the term benefit, tax benefits that apply in certain situations. I mentioned the medical device thing, and it was a statutory provision where this person could exclude some of their gain. It had been a startup and blah, blah, blah. But the tax professional was simply not aware. And the sort of the example I like to give is if you have, and let's just say a residential rental, just a single family house that you're renting, okay? And you go to your accountant and you say, I have to replace my water heater and furnace in this rental. What can I do with that? And the question is whether it's going to be characterized as a repair or a replacement, in which case it would be a capital investment versus a maintenance item. Okay, so that's the first thing. But if it's a capital expenditure, can this thing called the 179 deduction be applied, or must it be depreciated? And over what period of time? Okay, your average CPA, I'd like to call your mom and pop CPA, they're going to know that question down cold, because they probably get that question 20 or 30 times a year. Okay? But then ask the question, I'm going to sell a 20, 30, $40 million company. What do I need to do to minimize my taxes? If they have one of them in their entire career, they're lucky. Okay? It's just not a question that's posed to them on a regular basis. Now, I'm not, citing fault. I'm just citing the reality is, for your average CPA, how many times are they going to be asked to do tax planning for a $20 or $30 million company? Okay. Now, they may be doing the taxes, the income tax for it. Okay, fine. But the tax planning unique to the M&A environment, and that they don't. And even, I will say, and this is, I'm just trying to sort of state how things are, and I'm not trying to be critical, but even many professionals in the M&A environment are not the ones who say, I need to keep learning, keep learning, keep learning. A lot of them are just, I've got my meal ticket, and they just sort of go along. And they're not exposed to new ideas that maybe have been around for a long time. So like this particular trust that I mentioned, where we can move the effective tax jurisdiction to Nevada from wherever the client is for the sale. I said the IRS has made probably about 100 positive rulings on these structures, and these structures have been around for over 20 years. So we really have a good idea how these work, that they're going to get approved, and that they're going to be respected. But ask the broad population of professionals, even professionals in M&A, and they're probably not going to be familiar with it because
it's because Todd, like, and yeah, I totally agree with you, and that's why, like, in our boot camp, we have like literally, how do you hire the right people in each of these different designations? Is like the conversations that we've been having does ripple into legal, tax, wealth, and M&A. It's like one conversation of, should I do my ESOP today or not, impacts your deal structure, your corporate structure, your taxes, your wealth plan. I mean, your real estate, is it going to be included in the real estate or not? It's so much stuff that not a lot of people, I kind of think about it as like, when you're building a house and the general contractor, all the different contractors have a general idea of how the building's getting built, but someone's in charge of coordinating all that stuff because they have an understanding of how everybody else works.
yeah.
This is like everybody trying to build a house or a building without having any idea what the blueprint or the budget is. I mean, it just which the chances of disaster, because the owner, in turn, by not doing this stuff, is choosing to be that general contractor and architect, whether they like it or not.
Yeah, and in a way, a business owner's decision to defer planning instead of doing it now is, I mean, a de facto being the general contractor.
Mm-hmm.
Okay, because it's a decision they're making to keep things as they are, to not change the porch or change this bedroom or something in the business, and then the out of the blue offer comes and you're stuck with the decisions that you have made regarding your business. And so by choosing to defer planning, you've assumed the general contractor role. And so to that point, this goes back about 4 years. Someone that I know had a retail sports operation, pretty good size, revenue about 50 million a year, had multiple retail locations, and so he had said, and this was just in a social context, we're sitting at a bar at a social setting and just chit chatting, and so he says, "Is same thing? Okay, sell 3 to 5 years." Okay, and so someone else had been talking with them about accounting systems and whatnot. And so I had, and I'm not in the business of selling accounting software, I'll say, but I had suggested that he look into a particular type of accounting system. And he said, "Oh, that's good." And I said, "And if you implement this particular type of software, the likelihood is you're going to get a little bit of a pop on your sale price if you get it executed properly." And okay, great. Well, 2 weeks later, he comes in out of the blue offer by one of the people or entities he thought was the likely buyer for his, because there's only so many in this particular field. But anyway, he says he got an out of the blue offer. Well, so his company was sold as it was, and had he put this software package in, the likelihood is he would have got a pop, and probably in his case it would have been worth maybe about $1.5 million. So that's not really related to tax, but the point is still made, is what happens, what's the net effect of the business owner saying, "Well, I'm just going to put this stuff off." And the answer is
you're solving
you're the general contractor.
Right. And you know what, I've been gravitating towards this phrase now of you're choosing to solve for annual income instead of solving for value creation on your net worth and on your business. So if you shift that mindset, which is literally going like from 2-dimensional to 3-dimensional thinking, then you're solving for value creation. So outside of the business stuff too, and we kind of, to wrap this in and kind of bring this full circle, is as we look at the advisors and what you were talking about from the operational and the structural things in light of those financial targets of the capital you need, the income you need, and then the excess. Is there things that when you're looking at these decisions of ways that people can say, okay, my advisor's there's a return on investment of this planning fee or this estate fee or this tax planning fee, because knowing that I've gone through the due diligence of hiring the advisors that get this shit, then how can you say, okay, this is the return on the investment that I should get? Because, and one last before you answer is that when I see this stuff, Todd, like, because I understand the world that we've been talking about, when I hear someone explain their back end structures, I cringe because I know what was lost by not the lost opportunity. But you almost, it's hard to compare because the situation never happened. Like, you didn't have apples, you didn't have the comparison of what you just said of, like, if you would have done the ERP system here, like in this situation with the team of advisors, and they're looking to hire the people, and like, what is it that they should be asking or quantifying as far as paying the people 1 to 3 years out before that eventual triggering point?
Well, so the simplest example. Okay. So let's take you. Okay. You're going to be this business owner's advisor. And let's say it's a $20 million revenue company. Okay. And you say, I'm going to increase your net margin by 1%, one rotten, stinking percent. And the owner is going to say, well, what, 1%? Are you kidding me? How much am I going to pay you? Okay. And so, but let's think about this a second. On $20 million, that means an increase of annual cash flow of $200,000. Now multiply by a real conservative 5-time multiple. Five times. You're talking $1 million in value creation. Mm-hmm. That's what the rotten, stinking 1% translates to. And so you go in and you say, well, all I'm going to do, I'm not going to do anything more, is I'm going to expand your net margin by 1%. And again, the business owner on the surface is going to say, well, I'm not going to pay you for that. Oh, but then part two is, the second shoe to drop is, but then that's worth $1 million to you. So maybe as a professional, my fee is probably, I've got to believe that's going to be, I don't know what your fee structure is, but I would say it's going to be multiples. Okay. Something and then the next thing is, well, but what if it's 2% instead of just 1%? Right?
Well, I think on the cash flow and the multiple, that is, that's been kind of our approach, and I think you can, because we're bringing in both the value enhancement strategies and then also the team of advisors, helping them build that. So like, then on the team of advisors, the outside, like the tax, wealth, the legal, your kind of skill sets. How do you do that? Because it might not be directly cash flow multiple related, but it's more the deal.
Sure.
That makes sense. So how do you approach that same thing on your side, knowing that, like, when people say, like, because I didn't know we left money on the table until talking to you, then I'm like, well, shit, I wish I would have spent X to get $1 million return. Does that make sense?
It's difficult. Okay, it's difficult. So many times, as I mentioned before, that so many professional advisors like to work as a silo. And so one of the things often is the case, is we get in there, and because we would set up a trust structure to be the owner of the company, well, now the trust is paying the income tax on the net income. And so the trust, us as trustees, we need to know, well, how's the accounting going on inside the company? Mm-hmm. And when we start looking at that, so many times these business owners, they've started out with their old time CPA, the mom and pop CPA, and maybe things aren't really done that right. And yet you end up, so the gentleman that I said that had the sport retail shops, this guy still had, at 50 million of revenue, he still had his mom and pop CPA looking at the books and doing the tax returns. He did not step up in level to, a professional who would be there. And so this mom and pop is going to be a little resistant. Well, what do you mean I'm doing things wrong? Well, yeah, your revenue recognition is wrong. This is wrong. We don't want to be in a position to make anyone, look bad, but this is what happens. And so so I bring this up is the business owner really needs to understand that this interplay is essential, because now what happens is what if something going on with just the accounting inside the business is not exactly right, which then compromises the tax structure that we've put in place. Okay. And anyway, I mean, it's in a way it's hard to explain because the nuances are so subtle. But just in this example,
very expensive though.
What if the way that your accountant is representing, the income and this and that, what if somehow that compromises the tax structure that we put in? Mm-hmm. Okay. Or what if we put the structure in and you say to your investment person, whoever that is, well, we need a distribution of this. Well, there's a formality of how you get the money. There's a mechanical route. And if your investment advisor just says, cut you a check and says it can compromise. So everyone does need to play together. Okay. Mm-hmm. And I mean, I have to apologize because again, these nuances can be so subtle that you just don't think about this. And I always tell the families we serve, it's not like I'm this obsessive compulsive guy who likes to line up my pencils all in a straight row on my desk. Okay. Certain things have to be a certain way or everything gets compromised, not only from a tax perspective, but from an asset protection perspective. Is there's the form and there's the substance, and both need to be there. And one thing that one professional is doing can absolutely undermine what everyone else in the picture is doing. So everyone needs to know that they're part of a team. And in some cases, the professional needs to subordinate themselves to that team and not, well, I'm just going to,
to the bigger
how
picture,
dare you say, how dare you say my revenue recognition is incorrect? Well, it is. Okay. I mean, I don't want to make anyone look bad, but that's the thing. And
but I think it's to your point is like once you have the blueprint and you understand where you're going, it's just like the puck. If you know where you're going to the puck, then everybody can ebb and flow to who's needed at the moment to solve for that puck. I mean, otherwise, and that's what kind of goes back to the whole point of this entire show and this episode is that if the owner understands, so the listeners that are thinking about this stuff, and it looks like a lot, is understanding what you want and what you're trying to solve for from the dollars, from essentially the 5 principles, then they literally can watch, because here's my kind of my final takeaway, Todd, and then we can kind of wrap it up and give you the listeners your contact information. Is like if the owner understands what they want, they're good at hiring people for the most part, right? I mean, there's pros and cons, and there's trials and tribulations of not hiring the right person, but you can, instead of trying to be as smart as your tax attorney or your CPA or your wealth advisor, if you understand what good looks like, then you can hire the right people because you know where you're trying to get to and how they're responding to even that situation that you just brought up, right? If someone responds and like you just said, and they got all defensive, that they're probably not either wrong, or they're either wrong or they don't know how to be wrong, which is a problem regardless. So I don't know, like, if you got any comments on that and explaining, how maybe kind of explain your team, how you fit into that, and what the best way to get in touch with you is.
Okay. So I guess, fundamentally, each professional advisor needs to subordinate themselves to the overall team. And no one can accept that they're always right. Okay. Baseball great Ted Williams is the only player ever to hit 400 in a season. And yet he only hit 400. Okay. Right. Okay. He only had an on-base percentage of 500. Okay. So no one out there is perfect. So each person has to accept that there's something they don't know, or maybe something they're doing wrong. It goes back to that lifelong learning concept rather than I got my meal ticket.
Mm-hmm.
So if someone is committed to a team and they're willing to subordinate themselves, admit that they could be wrong, okay, be open to other ideas, and then fairly deliberate what those uh, ideas might be, okay, then you're serving your client, okay? That's
Mm-hmm.
the key. So, but in all of this, you said, put out my contact information. I have a lot of information, articles, and so forth on my Forbes column. So if anyone were to simply do an internet search on Todd Ganos, Toddganos, and then Forbes, you'll find my column, and we talk about a lot of these topics. Someone can also go to our website, which is integratedwealth.com, and my email is Todd, Todd, at integratedwealth.com.
Todd, it's been so much fun having you back on the show. I appreciate it, and I appreciate the passion and the mission that you're on, because I think we're all, it takes everybody to try and solve this big problem.
Well, great. It's always great talking with you. We've had some pretty lively conversations over the years offline, and always interesting. So thanks so much for having me.